All right, so today I've compiled everything I've learned in the past 2 years of trading into this really, really long free YouTube course. Everything has its own details, and it's going to be pretty intensive, right? It's going to be pretty knowledgeable. And we're going to be starting to go from very beginner concepts to more advanced stuff. So there's going to be timestamps down below that you guys can skip around. I promise you, you will learn something even if you've been in the trading space for a pretty long time. To start off, let me talk a little bit about myself. I guess you could say it's more like module zero. I am S2 Trades. I've been in the trading industry for almost 2 years now. And I've been trading since high school, basically. And I've been trading a lot, right? I've have like I have live streams where I trade for free. I've been funded with Top Step and Alpha Futures. I'm actually partnered with Alpha Futures. More on that later. But let us actually just get into the course. So basically, what I want to start talking about is this is just the beginner stuff, market foundations. What really is trading and how does it work in the background, right? So this is not no retail bullshit. This is just how does trading work in the background. I won't be going crazy in depth about this because I know most of you guys don't really give a shit. But like I won't be getting into like market making, for example. But just the beginning of what trading is. Basically, it's just buying and selling. Historically, there's been trading markets all around the world, right? It wasn't anything. What's it called? I forgot its name, but we weren't trading securities. We were trading more products. We were trading more items, right? So if I was a farmer and I wanted your sheep, I could trade you my cows, right? My cows for your sheep, or my hay for your eggs, and there are little bit of like there's some trades that actually give you value and there's some trades that you lose value in, right? And that's basically what trading is. You're buying and selling. So basically, let's say I want a price, or I predict a price will go up. I want to buy low and then sell high. That's like the most basic it's gonna get. I'm gonna want to buy low and sell high. That's a long entry. There's also a short entry where I kind of sell low and then buy high, but that kind of seems a little counterintuitive. There is a lot of stuff that goes back end in the brokers and stuff to this. It's more of like a logical concept, but just know you could short by predicting, or predicting isn't the good word. I guess you could say expecting lower prices, right? And it only gets executed, or like prices only move because orders are getting executed. So within markets, like within TradingView, there are different types of orders, right? There's direct market orders, and there's limit orders, and there's limit stops or whatever, right? It only moves because there's orders being filled and there's movement being made. This is the liquidity that's just moving the charts, right? And trading is not predicting candles, it's understanding where orders needs to be filled. There's logic that goes into this, and I'll talk about it later on, right? So basically, again, let me explain shorting. Basically, shorting, you are selling at a higher price and I'm buying back and I'm covering at a lower price later. And this is basically some back ends that's happening with the brokers. They're hedging the stuff. And it's also really important to note that nobody's actually selling your orders like on Wall Street manually, right? This is we're in the modern day era. This is all happening electronically, right? And that's why you can also tell on your charts there's different time zones. There's the electronic or extended trading hours, and there's the regular trading hours, right? So basically, I talked a little bit about this market orders and market limits. Market orders is like I want the price now. So whatever the price is, so whatever the candle is at right now. So right now I'm on the gold futures. I'm on a fresh funded account. I'm gonna try to get past this evaluation. But you see right here how it says 42271. It's like I'm buying or selling at that price. I want it now. This is what most of you guys are gonna be trading. You guys are gonna be trading market orders, okay? But like limit orders is I want a price to be filled. Like let's say right here, I could set up a limit order, right? A limit buy. Let's say 2.
Order rejected.
So, oh wait, sorry, the markets are closed right now. But if I set up a limit buy right here, once price touches here, I'll be getting filled in, and that's when potentially I'm expecting it to go long. That's where I'm going to be going long. Basically, this is more precise. However, there's some logic behind this as well. More of like the I guess you could say the passive buyers are passive like market participants are using limit orders. Uh, this could also be caused like this is a little bit more advanced. This could be they could use this as a way to kind of iceberg entries, right? Kind of fake entries, and that shows into the depth of market, but that's just a little too advanced for whatever I'm talking about right now. So prices are moved through algorithms, right? Algorithms. It's basically people that are trying to push the price to certain levels based off of specific ideologies and concepts, right? So there's liquidity pools, and these are areas of like, for example, like equal highs, equal lows, prior swing points, right? So these are swings. So like for example, right here, this is a swing high that has a bunch of liquidity backed behind it, right? And you can, mix it up with other stuff in the background. For example, this area right here. And as you can see, once price reached that area, or we passed it a little bit, we had a big reaction down. You could have had potentially a lot of shorting opportunities during this time frame right here, right? We had a little bit of move up manipulation to this liquidity zone, and then we started pushing down. So these are actually called sweeps. These are sweeps of liquidity, and prices usually just sweep the liquidity and then go towards the other liquidity zones, right? I'm waffling a little bit because I'm not going off a script. This is just pure brain dump. But basically, these have stop losses that need to be hunted, for example, right? And there's high frequency trading, right? So the market isn't random at all. The market, people think like the markets are manipulated. There's brokers hunting it. However, what you want to look at is that the high frequency, let's call it trading firms, actually what they do is create micro inefficiencies. So what they want to do is they want to create imbalances in price. They want to move faster. If you look at it like on a deeper level, these quant firms, right? These high frequency trading firms, they trading on the milliseconds, right? They're trading on the nanoseconds. They want to receive price at the best fill. Because of that, they have these algorithms that are pushing price towards certain levels. They're not afraid to lose a lot of money to, or like I guess you could say, not these are not more quants. These are more like, let's say, like hedge funds. They're not afraid to lose money to push price to a certain level so that they could make money. They can make more money from that, right? One thing we want to know is that actually prices, like the algorithm has structure towards it. So we have a sweep, which I mentioned before. This was a sweep. We took out liquidity zones. We tapped into a little bit of a liquidity pool, right? We had a displacement on a lower time frame. We could see, like even on the 5 minutes, we could see right here, right? We started making displacements. We started creating gaps in the market. I'll talk more about that later. And then there was a retracement, right? I guess in this case there wasn't really any retracement, but usually what happens is there's retracements that tap back. Actually, there is a retracement right here. I didn't even peep that. Right here, there's a little bit of a retracement that we occurred. So boom, we pushed down. We had a little bit of a retracement. I'll talk more about that later. Into an inefficiency, into a gap in the market, and then we dropped again. All right, that's the structure to it. And then there's that was the continuation of the retracement. And then what did we do? We followed the framework. We hit the target. These were the targets. I can even predict it or expect it to go even lower, to lower till here. Take these liquidities out, right? I would have been out of the trade during, like, once we took this out, but that's because I like to be a little more risk free, right? I don't like to hold trades for long. But one thing you guys are wondering is like, okay, I want to learn trading because I want to get rich. But this is where the paradox comes in. How can I get rich from trading if I don't have money to trade? So you can opt in for funded accounts. These are other people's capital. This is not your capital. This is capital of prop firms. The way that they work is you have to join them up. You have to pay like a monthly fee until you pass these accounts. Once you pass these accounts, they give you sometimes there's an activation fee, but once you pass these accounts, they give you a funded account. Right now, what I'm on is I guess you could say a funded account. This is an evaluation. Wait, let me show you guys right here. Proof. This is evaluation. So this doesn't mean I have the money from them. It's more of an evaluation state. I'm I'm getting evaluated. You need to reach a certain profit target. So in this case, it's a $50,000 account. I need to make $3,000 from it. Once I make the $3,000 from it, it's basically like a live account now. It's at the start, it still is simulated funds, and they're paying you out of their own pockets. But that's just their business model. Basically, you could treat it as if it's a live account, and you basically get to keep a percentage of the profits you make, right? And the reason why this is good is because there's less emotional risk to it, and you don't need to have your own capital. If you have money right now, that's good for you. You could actually trade with your own money, and that's gonna actually help you out a lot more. But what the heck? Give me my. Oh, I think some people are working on the thing right now. But what in the world, bro? Okay. But basically, some people were helping me with the Myro, and I guess they're just editing it up now. Basically, you could. It's like it's better to do it with your own capital if you have your own capital. But if you don't have capital, you can opt in for a funded account. Mind you, also that it also lowers your your emotional risk. A lot of trading is psychology. A lot of trading is mental. So if you are over here trading with a lot of money, and it's your specific funds, your hard-earned cash, and you start losing the money, you will freak out. The fact that this is a funded account, you're not susceptible to that level of emotional risk. You still have the emotional risk, but it's not at that level. And also, funded accounts are super scalable. Once I get one funded account and I get a payout, I use that payout to purchase more funded accounts. I pass the valuations and I copy trade, and then I could lower the risk per account, but I could continue scaling it up. So let's say I made $600 on 5 accounts, right? I scaled. It's like I lowered the risk per account, of course, because it's $600 profit, but I scaled it up. However, what you guys want to understand is that getting a funded account, especially at the start, is a little hard. It's hard because, first of all, your psychology. There's like people enter in random entries. You don't have any specific system. You guys break down your drawdown rules, so they're not just gonna be giving you money. They're gonna be giving money to the actual profitable traders. But we can use ICT, and I'm talking about advanced ICT, not some bullshit like, oh, fair value gap, like pattern trading stuff. We can use advanced ICT to help us trade, right? Because ICT is time plus price. We're not only looking at just like stupid patterns, and that's what actually pisses me off in the industry. Whenever I see anybody making a course like this, they talk about patterns. We're not trading patterns, bro. So basically, just a summary. You guys can read this bullshit later, bro. Okay, so market structure logic. This is where we start getting a little bit more advanced. Slowly, we're building up. Basically, the markets work in a premium and a discount. We learned this in economic class. The premium and discounts could occur within ranges of the move. So right here, you guys see it? Yeah. If I have like a little bit of a range, I don't have any fib settings here right now, or not settings, like any of my usual chart settings, because I'm planning on doing it with you guys. But for example, or actually wait, I guess I forgot to remove it, but right here we have a like a range up. Right here in the middle, that's the equilibrium, right? So if I were to expect, right now it failed, or actually let me show you an example where it did work. So right here in this candlestick range, right? This candlestick range, if I wanted to find any long entries to continue for it to go higher, I want to find it below midpoint or at the midpoint of this range. This is the equilibrium of this price range. This is where we are having a an equilibrium of supply and demand. Prices here are perfect, right? Anything below the midpoint is a discount, and anything above the midpoint is a premium, right? You don't want to buy in a premium. So imagine you went to a store and you were purchasing like an apple, right? Like a fruit. You want to buy it at the cheapest price possible. If they pumped up the prices and now a singular apple costs like $10, for example, like, yeah, if it's necessary, you will buy it, but you'd rather wait for a discount, like a sale or something, that would push the apples down to, for example, $2. Same here. You could technically long there, but you're not going to be getting the best entries. You're going to be getting lower tier entries. It's better to enter off a, I guess you could say, a discount, right? A discount, long it to the next liquidity zone, which was the swing high I mentioned earlier on in the course, right? This liquidity sweep. But yeah, there's the equilibrium, there's the discount, and there's the premium zone, right? So equilibrium is the 50% zone of the range, like I mentioned before. So basically, it helps you avoid chops and what's it called? But here's the thing, okay? Like I'm just gonna end up repeating everything here. That's why I changed my mind. But what we don't use equilibrium for is what's it called? Bias alone. You could sometimes use it for targets, but you can't use it too much for entries, right? So sometimes whenever I'm trading, like I won't, of course, not all the time would I use what's called equilibrium for a target. Usually I'm just targeting other liquidity zones. But let's say it's like a big move down that I'm trying to catch. Let's say I was trying to catch like a long, right? From here, long from here. This is a big push down. Like obviously this is the drawn liquidity that if we were to long, we would try to take this out. But I would take partials at the midpoint of this range just because like I don't know if it will start retracing or not, right? I'm hoping or I'm expecting it to not to, but it's better to just kind of de-risk. It's not like, why would you just risk your money, right? Also, wait, before I continue on this, there's also time based, or I guess, yeah, wait, I forgot I talked about that later. Oops. But there is deep and premium discounts, and there is there's deep, premium, and discounts, right? So these are extreme like premiums and extreme discounts. This could be seen with the optimal trade entry, which I'll talk about later on. This is, I think you guys probably seen something like this before, but let's go back to the 5-minute place where I had that marked out. I'm actually going to test it out. I don't know if it's here or not, but if it's like visible on this one. But yeah, as you guys can see, this zone right here, and I'll give you guys the settings for this later, between 6.2 and 7.9 right here, this is 62% and 79% of like the overall move. This is where we have deep discount, right? And if I reversed it and I was like trying to look for longs, in this area is where we have deep premium. So I marked out that move right there. This is where we have deep discount. In this area right here is the best area to long, right? We are deeply past the 50% zone. We're not too deep down where it's like, okay, we're going to be like, retracing or like reversing, but we're deep enough that you can get a good fill. The best price point you guys could long at is the 0.75 or 0.705. This is the best price point you can long at. If it taps here, what happens sometimes, and if I could find an example, I'll show you. What happens sometimes is it taps into it, literally wicks, and it continues going higher, right? And vice versa for shorts. That's the optimal trade entry. So you guys can also use this for fair value gaps. You guys could use the same knowledge with fair value gaps, right? So let's say we have like a fair value. Actually, wait. Should I wait till let's talk about fair value gaps? Yeah, I should wait till I talk about fair value gaps. This is a little bit of foreshadowing of what I'm going to talk about, right? But one thing we also want to know is there is time to it as well. So if I have, let me delete everything I've drawn before. If I go into the 1 hour and I mark out midnight open, right? Midnight price open, and I'm assuming you guys know how candlesticks and stuff work. If I mark out midnight price open, right here is where if we're above it, we're probably going to short for the rest of the day. And if we're below it, we're going to long. So if we open up below it, we were going to long. And one thing you guys can also see is we kind of bounce off of midnight open sometimes, right? We use it as like a, as you can say, support and resistance, which is kind of like a bad terminology for this. one thing also other than midnight open is like so basically we can use midnight open to find draws, and we can use midnight open to find a bias. So if I'm longing or if I'm shorting and we're super above midnight open during like macro time, see like around 10:30, or not, sorry, not macro time, like around 10 a.m., 10 to like 11:30, if I were to short around this time, my draws would be midnight open, and see how it aligned with this draw on liquidity there. That would be my profit target. I could go lower, but anything lower than that is just, it could just be seen as greed. I like to target midnight open. Another thing we want to look at is 8:30 open. Right, so let's mark out 8:30. Right. Let me actually just make this look cleaner with my actual settings. Midnight. So 8:30 open gives us another form of volatility open, right? So if we have an 8:30 open, we can look at where 10 a.m. is, where like 10 a.m. to 11:30, the time frame I told you. If we are above it, like during the 9:50 macro-ish time area, and we took out liquidity zones during this time as well. See, like at 10:30 we took out liquidity, and we're both above 8:30 and midnight open, we are in a deep premium. It's really, really high probability for it to short, unless some major news event comes along and just starts pumping prices even higher. We are very, 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 very certain to short around this time zone, right? Just keep that in mind. And yeah, you can use it for these stuff right here as well. You guys could pause and read. I want to go a little quicker because I just realized this is 21 minutes deep. We also want to look at the structure of like the flows, right? So what happens, this is like a very, very simple model. This is not something I trade anymore, but when I did begin trading, it would be like a sweep and then a break of structure, and then fair value gap appears, trade into optimal trade entry, or like any different PD array, for example, another fair value gap, and then we continue to price targets. If you don't know what any of this is, it's okay. I'll be talking about this later, but just to give you like a little bit of a breakdown, or like a little of like not a breakdown, but a little bit of a simple explanation is like, okay, let's say we have like a little bit of a move, like I mentioned prior, where we take out like a liquidity zone that I talked about. We come down, or actually wait, let's not take away liquidity yet. Let's say this takes liquidity. We come down, we close below the past like swing low of like the range, and then we trade back into like optimal trade entry, or like another PD array, such as a fair value gap, inverse fair value gap. Chances are we're going to come down to this draws on liquidity and take them out, right? So let's see if I got that perfect though. The optimal trade entry area. Yeah, see? That's how you know, bro, I've too much chart time. Got the OTE almost exactly perfect. Let's say we had something here, and then some sauce right now, a little bit of like a pre-move. I'll teach you guys a little bit more about this later. But let's say we also had a fair value gap here that we tapped into, that aligned with the optimal trade entry with the consequent encroachment of the fair value gap. This is a high probability short. This is a super simple model. You guys could take this right now and potentially pass your funded accounts. But if I were you, I would keep watching this video because I have a lot more sauce coming in. Yeah, so basically these are just quick rules for the structure of the market. We want to have a little bit of a checklist. We need to know if we're in a premium or a discount. We don't want to short in a discount. We don't want to long in a premium, right? And we only trade extremes, right? We trade the swing highs, the swing lows. This is like if you guys took math, right? Like you guys know local extremes, global extremes. Right now we're talking about local or I guess it depends on the interval you look at, but we want to trade only the extremos, right? We want to look at midnight open and 8:30 open just to confirm the direction. Pair it in with time, pair it in with the macros, which I'll talk about more later again, and just see where it goes. We want to see a sweep, a displacement, usually with fair value gaps. We usually take out we create inverse fair value gaps. We form fair value gaps. We want to retrace into that range, into let's say we're shorting. We want to retrace into a deep discount in that area and then continue down lower and take out more liquidity, right? So, but what is liquidity? Wait, let me go get water real quick. All right, so I'm back. Right now we're going to talk about liquidity engineering, and basically it's how price moves from liquidity to liquidity. In our case, we're going to be only looking at extremas. Some people trade it into fair value gaps or whatever, but we're looking at the extremas. How price moves from one high to another low to take out that high again to the low, etc. Right? So, but first thing we want to talk about what liquidity is in like I guess you could say the retail sense. Liquidity is just a cluster of orders. Liquidity usually sits at equal highs, equal lows, at swing points, and at the Asia range, right? Asia range being like a specific time frame. I'll show you guys that stuff a little bit later, but it's basically made up of buy stops, sell stops, stop losses, resting orders. You know how I mentioned like limit orders, basically those like orders right there. And why does it matter? It's because it helps us predict and also target specific price points. So actually, before I continue, let me show you guys something cool. I don't use Top Step anymore. Oh, not Top Step, sorry. TradingView. I don't use TradingView anymore. But there's this thing on the TradingView which you guys could get to see what I'm talking about. It was ICT kill zones and pivots, right? If we look at Asian session right here, this is what I meant by the Asia range. If we look at Asia session right here, we have a bunch of consolidation. A lot of liquidity is usually built up during Asia session, which is why you don't trade Asia session at all. It's better to trade specifically New York because it has these strong displacement moves, and sometimes London because London also has stronger displacement moves than Asia session. But if you trade Asia session, if you look at Asia session, usually it's just straight consolidation. We stay in a little bit of a range and we build liquidity orders. That's all it is, right? Asia session builds orders. We want these orders to be filled and just target these orders. These are the resting orders I was telling you about. There's a bunch of stop losses that were formed and built around this time zone that we want to target. All right, and I guess like I won't talk about Asia session next, but I just got it out here. There's also liquidity sweeps, and basically what a sweep is, I kind of mentioned it a little bit before, but it just when we touch into a zone, usually it's like past session liquidity. For example, like if you have a swing high that we take out, like look at this is a perfect example. We took out a swing high in the markets right here, right? Swing high. Let me turn this stuff off. We took out a swing high and then we dumped. This is a liquidity sweep. There's liquidity that was built around here that we swept. Now this is really, really perfect. This is a really, really perfect example because not only is this the highest point during London session, so it's marked out from here, London high and London low, which is something we want to always mark out on our charts. So London highs, London lows, the midnight open, the 8:30 open, whatever, right? But not only did we take out the London high, a very prominent draw on liquidity, and then dump, or even here, like you could have had long opportunities here where we took out London low, a very prominent liquidity, and then pumped to London high, took London high out, and then dumped down to other liquidity zones that was being built up previously, right? On a different scale. But we also have equal highs here. This is a very good example because look, there's 3 highs that are made that are relatively equal, right? These are very, very, very close together. So obviously the markets, they want to attack this area right here, right? So if I were to draw something out like this from the highest to the high point, like let's do like FEG. Let's do FEG. I think I have a midpoint set up on it. No, I don't. See, this is like my old settings. But yeah, see this area here. Let's get it up to the high right there. this area that I have marked out from the highest point to the midpoint, like this area right here, is a bunch of liquidity orders that want to be filled. We want to go into it and take them out. We want to go into them and just start shorting. Now, one thing I want to show you is we actually, if we look at this area right here, this is, if we go like more large, like more advanced, this is a balanced price range. If we mark out the quarter of that, that would be the liquidity zone, right? The quarter of that. But this is you don't really need to know this type of stuff. It's better if you do, but it's not necessary. Yeah, that's why you need to have that stuff out. It's like we target liquidity zones, we target liquidity sweeps. Going a little more into it, Asia session creates a range and forms liquidity. London session sometimes or usually sweeps out the Asia range and it starts displacing, and New York sweeps the London session and starts delivering, which then pushes into Asian session, which starts generating liquidity, so on and so forth. It's this perpetual cycle, right? And we want to target these liquidity zones. This is basically what I was kind of explaining here, the draws on liquidity, where I give you guys this example. You take out a liquidity zone, you target another one, you go down, you target more liquidity zones, right, etc. And not every high gets swept. You guys need to know that not every high gets swept. In this case, right, so let me show you the example with this case, or not every low either gets swept. This case, this low should have gotten swept, right? Like this would have been somebody's profit target. But one thing I need to know is that this low, whenever you see a wick like this, and this kind of comes with built-in intuition, whenever you see a wick like this, this could be seen as a rejection block, right? These types of wicks, they don't always get filled fully to the brim, but they get filled to the center point at least, right? And the center point is where the reactions happen. And see, I didn't even like see this chart at this time, right? Like I wasn't like, this is not in hindsight. Like, I mean, it is in hindsight, but this is like me just like marking shit out, and it's just like lining up. Just the midpoint of that area usually gets filled, and as you guys can see, boom, we never closed below that midpoint, moved up, we tagged back into that midpoint, and then shot back up and started slowly going back up to target the pre-market highs. Boom. That's the perfectest example I could give you guys. We start targeting pre-market highs. One thing I'm kind of curious about for my own sake is actually, yeah, no, I thought maybe we tapped into OTE, but we didn't tap into it, but we didn't close below it either. So that's something, I guess. Basically, the liquidity model, basically what we do is we wait for like a sweep, which is our trigger. We filter it using fair value gaps and break of structures, which I'll talk about fair value gaps later on. I mentioned break of structures before, and we basically execute, I said basically a few too many times, but we execute off of a retracement to order block, another fair value gap or an inverse fair value gap, optimal trade entry, and we target external liquidity. Okay. All right, so you guys are gonna get more into fair value gaps later, and this is just a quick summary. Pause and read. So this is where we start talking about fair value gaps. Fair value gaps are imbalances in the market, right? So whenever some people, the way that people teach this, like the most common way to teach a fair value gap is a kind of like a candlestick pattern, but it shouldn't be treated like a pattern. So whenever you look at 3 consecutive candles, right, there's a few right here. Let me show you like the biggest example here. 3 consecutive candles, 1 candle, 2nd candle, 3rd candle. In this area right here, from the wick to the wick would be a fair value gap. Actually, like in this case, it wouldn't be wick to the wick because there's a volume imbalance, but I'll talk about that a little later. Most of the time there won't be a volume imbalance, but let's say for this case, let's say there isn't in this case. It's from the wick to the wick. This area right here is an imbalance. Price wants to fill this area up, and we want to close above that wick right there. And that was like what we were doing. This can also be used, and this is like a fat fair value gap, and that's why it's like really choppy around here. And not to mention, there's also like the time that we're trading, like December, super choppy. But we're chopping about, trying to fill this up slowly. We did fill it up, and we targeted the liquidity area. Right, there's another fair value gap right here. All right, there's another fair value gap right here. Your homework for today would be just to go into your charts and mark out fair value gaps. Just train your eye for it if you don't know what fair value gaps are. But whenever you have a volume imbalance like this, right? Do you see how it's like a 3 consecutive pattern? And yes, we could go from wick to wick like this. This would be the fair value gap. But notice that there's like a little bit of like a displacement between the two candles right there. That's a volume imbalance. You bring that down to the open right now. This is a new fair value gap. Okay. Fair value gaps are very important to know because it gives you entries, right? It gives you it tells you where prices are gonna push. So yeah, see over here, just high to the low. This is the fair value gap. Fair value gaps are basically whenever we displace, largely fair value gaps are formed and we rebalance. So I guess the best way I can explain this, and it's a little bit of a crude example, it's like taking a poop, taking a dump. When you take a dump, let's say you ate a lot of food, and you take a dump, you ate some tacos or whatever, and your poop is just like everywhere. It's like just too much in the toilet. It can't be flushed down with one flush. You had such a large displacement down that we need to kind of flush it again. We need to rebalance back into it. We need to kind of go back into it to flush again and go lower, right? So in this case, let's look at like a fair value gap, that entry that worked, you know, like this right here. We had a fair value up there. We had such a large displacement after taking out these, like, you know, these highs right here. So we had a sweep. We had a big displacement lower. We created a fair value gap right there. You know, we inversed a bunch of fair value gaps there, which I'll talk about later. But we wanted to rebalance into here. So right here, there's still orders that need to be taken out. There's so much bearish orders that we need to come back into there and produce bullish orders. So we need to produce buys. There's so much sells that we need to have buys in here as well. So we move into there. We don't close, and this is a good sign. We don't close between the midpoint of the fair value gap, and then we dump. And we take out these liquidity zones right there. This would have been, you know, a nice trade setup right here. Having your stops there, having your profit target there. This is a nice 2RR trade. Bruh. Okay. But another thing we want to know when it comes to fair value gaps is that there's quarters to it as well. I don't know if I talked about that later. I did talk about that later. So basically, quarters, there are just touches to the fair value gap. So we don't want to, let's say I'm looking for shorts. The reason why this is a good short setup is we never close below the midpoint or the equilibrium of the fair value gap. See how that kind of ties into an earlier module I taught. We don't close below the equilibrium of the fair value gap. Oh, wait, why am I even teaching on trading view? Let me go to what's called a different one, just so I don't keep getting the flipping ads. So look, we don't close below the mid. There's a good example here as well. We don't close below the midpoint of this fair value gap. We actually stayed below it. This gives us good probability that it's gonna hold, and we're not gonna just run right through it. We're gonna continue shorting, right? One thing I seen a good example on like the trading view here is there's also quarters to it. So you can break up a fair value gap into fours. So I guess we can use this right here. Oh, do I have the quarters on this? No, I don't have the quarters on that. I have it on my fib. Yeah, I do. So you could break it up into fours, into 25% zones. We didn't close below the midpoint, which is good. But then we also basically, we basically tapped into this quarter right here, the upper quarter. So we were in a deep premium within this fair value gap. And that's why this was a very, very high area, like high probability area to displace lower in short, right? If you missed this entry, you could have entered off of this rejection block right here, the consequent encroachment of that, like the midpoint of that right here, right? This would have been another good entry. Um, yeah, that's fair value gaps though. If we are just below it and we didn't like kind of go too deep into it, let's say like we didn't like wick into it and we were just below it here, like yeah, that means the fair value gap might hold, but then also it's like it brings down the probability a little bit because you don't know if the next candle will just like displace right through it or not. It's just a shallow touch. We want like either a mid touch or like a little bit of a higher touch like this, but a wick down. We don't want to see a closure above the midpoint. Okay. Basically we have a fair value gap and an inverse fair value gap. I mentioned this before as well. An inverse fair value gap is basically a fair value gap that was disrespected. Oh, I'm sorry, chat. I'm super tired. Went to bed a little late. It's a fair value gap that was disrespected. So let me find a good example right here. This is like a newer example too. See how we formed a fair value gap, but we close below it. That becomes now an inverse fair value gap. All right, that's an inverse fair value gap right now. So this could be seen on different time frames. Mind you that the charts are fractal, and I'm assuming you're coming into the lesson knowing this. If not, you could check out my other videos where I talk about fractality and you know, more like a little bit more advanced concepts. But as you can see, we inverse this fair value gap. This is a this is giving us bearish ideas, right? We've inversed the fair value gap. This is giving us bearish ideas, and you can also find retracements in inverse fair value gaps as well. As you can see, I guess this is like if I scale it down a bit, this fair value gap before that we had that got inversed, it kind of aligns with this fair value gap there. So inverse fair value gap there. So let me just mark out this one instead. We inversed it and then we retraced into it similarly to how we usually do with fair value gaps. And then we had a nice strong push down. This area right here is this is a high probability inverse fair value gap trade because again, we didn't close above the midpoint, right? And if you guys can see, that kind of pairs up with a regular fair value gap. This mixture of inverse fair value gap and regular fair value gaps is called the balanced price range. In this area right here where they overlap, there's a higher probability for it to short. Mind you, we work in probabilities, it's not guaranteed. It's just a little bit of a higher probability. Or not even a little bit, there's a lot more into it. Then there's also first presented fair value gaps. So first presented fair value gaps are, as the name suggests, the first presented fair value. So if I hop onto MNQ, for example, this is micros, or yeah, this is like for NASDAQ. If we hop onto MNQ and we go onto the 1 minute time frame, and let's go to the let me clear everything off my chart. Let's go to the New York Open. Where's New York Open, bro? So at 9:30. So the first fair value gap after New York Open, this is New York Open right here. The first fair value gap after New York Open, so this fair value gap right here is a very important fair value gap, right? If we inverse this fair value gap, chances are we're gonna go lower and short and take out the lows. In this case, we inversed it. We did have a short, but it was like a entry into a lower time frame fair value gap. I mean, a higher time frame fair value gap to long. But you could have also caught a short entry just purely off the inverse of this first presented fair value gap, right? This is not too good of an example, but let's go to another 9:30 open, just so you guys could get the idea a little better. So boom, 9:30, the first presented fair value gap right here. Right, this is the first presented. We respected it in this case, and you could have used this respection or this fair value gap specifically as a short entry, right? Targeting these lows, potentially even lower if there's more draws on liquidity there, which I can't really see. But yeah, you could have used this as an entry as well. So keep note of first presented fair value gaps. There are ways that you guys could see which one will be validated or invalidated, because not every fair value gap will be like respecting one. uh Again, it's to do with alignment of the PD arrays. It's to do with how clean the gap is. Like if your gap is in the middle of like in a midst of consolidation, chances are that gap is not really going to get respected. It's going to get inversed, and then the inverse is not going to get respected either, right? The IVG won't get respected. Sorry, I just had to stretch. And it comes after displacements, right? So, or like a higher probability fair value gap comes after displacements, after we took out liquidity. So in this case, boom, we took out liquidity, we had boom, and we displaced. This fair value gap is a higher probability fair value gap. This fair value gap, I would like to see it to retrace into to find another short. That's what happened in this case, and it happens within sessions. Like you don't want to, like you gotta pay attention to the session. You don't want to trade like again Asian session and the fair value gaps there, because you're gonna get caught up into the consolidation, right? Also the fair value gaps, it depends on where we are in the price. So let's say for this one right here, right? And go equilibrium. See how we are above the midpoint of it? We want to short into a range that is above the midpoint. All right, we are in premium now, and we want to find short models. Boom, this fair value gap aligns with that, right? Now another thing I want to know. Oh wait, wrong tool. Bro, what the heck? Wrong tool. Let me get this. Boom. OTE. Let's see. Again, we are also, not only are we in premium, but we're in deep premium. We mixed it with the fair value gap, and we are in a deep premium of that fair value gap, and we are respecting the quarters. We're respecting the midpoint of that fair value gap. What happens now? This is a high probability short. See how I aligned everything I taught you guys? This becomes a higher probability short. Keep this in mind, right? Oh wait, what the heck? I forgot to plug myself. No. You can use code S2 for 10% off of Alpha Futures. Fudge, I literally forgot to plug. I was too locked in. Yeah, and basically this is just a rebalancing map. Whenever we have a low swing, fair value gap forms, a high swing, fair value gap forms, and we just like, you could just bounce back and forth to the liquidity target. So fair value gap decision time frame. Did the displacement occur before fair value gap? Yes. Then go to the PD alignment, check. Is this in premium or discount? Yes. Evaluate the quarter of the fair value gap. So it's kind of like what we did here. Is it not? Then no. Did we displacement occur before the fair value gap? No. Then you just ignore. You don't want to trade everything. The less you trade, the better it is, actually. So let's talk about, oh my days, this is gonna take a long time. Wait, let's just see something. Okay, I have time. All right, so let's look at the module of order flows, and like we want to talk about like order blocks. Basically, what an order block is the last opposing candle before the displacement. So basically it's where institutions entered, and it occurs, it's like there's an entry, fair value gap, and an expansion. So like a good order block would be kind of like the last opposing candle. So we swung up, this would be the order block. We would tap back into it, right? We tap back into it. You guys could also have gotten a short around there, just strictly from this order block right there, right? I could just find many examples of that. There's just super consolidation lately. But let's just go back to when like there's like nice price action. 5 minutes. Let's just see like on a higher time frame. It's December 1st. Wait, I don't want to be in December. December just has pretty whack price action. Right, November. Boom. Wait, this is a clean fair value gap right there. But in session time, let's see, New York session, there's probably going to be one around here. You know, this right here, this is, we took out the low. This right here would be an order block. In this case, when you close above it, it becomes a breaker, and we never retested it, so you would have never caught an entry off that. And mind you, this is on the 5 minute. If you lower it down the time frame, it's gonna be a lot better. But then again, like right here, this order block right there. In this case, it failed. We're close below it. But here, look at this one. Look at this order block. This should be the order block. Main above it. Boom. Respected. Boom. Respected. Boom. Still respected. Right? Mark them out. This is kind of what I just talked about right now. And there's a difference between an order block and a breaker block. So kind of how I mentioned before, if you close above the order block right here, this order block, so technically we should have been shorting around this area, but since we displaced above it, this becomes a breaker block. Now this in itself could catch reactions off like that, similar to an order block. Similar to an order block is going to catch rejections, and this in itself has its own concept. If you take out liquidity and then we close above like the last range, this becomes the change in state and delivery. This kind of just makes us understand, like, okay, the order block didn't work, we took out liquidity. You know, we look at other stuff as well that I mentioned previously in the video. This increases the chances of it going shorts. I mean, it going longs. Just we closed above it strictly, so boom, we're gonna go longs now. Or like it's a higher probability for us to go longs. And that's what occurred right now. That's change state and delivery. So breaker blocks are change state and deliveries. And I talked about that here. Change state and delivery is just literally a breaker block. And it returns to the breaker block, kind of how I mentioned before. And you could also catch longs off the retracement to the breaker block. Now, here's the thing. Some people also mark out breaker blocks, not from the wick. I mean, not from the body, but to the wick. So in this case, this would have been somebody's change state and delivery. I usually mark it to the wick because I like it a little deeper, but see how it kind of touched into there and then retraced? You guys could have caught an entry off of that as well. Just a breaker block and a displacement, which is a change state and delivery. And we need to look at context. Basically, we need to be in premium discount. It must align with the session. There must be like clear sweeps. There must be clear displacements. The order block must be clean. And breaker is only valid after failure, right? And mind you, when I say clean order blocks, clean displacement, clean sweep, if you're a noob, you'll be like, oh, what is this guy talking about? But you need to kind of have a lot of chart time, and it becomes intuition. Like now I could look at the chart and see where we have clean structure at. Before I wasn't able to, but now I can because I have the chart time. And then we need to look at also the purpose. You need to align it together, right? So you need to look at the order block as like a retracement entry, breaker as a continuous reversal, and change state and delivery as like a high conviction reversal. Once we have a change state and delivery, we have like, okay, we're going to understand that now we might be reversing. You need to align it with the narrative. Don't just trade this. And here's the issue. A lot of people are going to trade this as a pattern. It's not a pattern. You have to align it with logic. There has to be something backing your idea. And usually that's time. And boom, this is just a little bit of a summary. Now, here, I'm going to go a little more in depth about the OTE. I've been using it a lot throughout the course. It's like the optimal trade entry that I was mentioning right there, this area right here. Let me give you guys quickly the settings to it. Settings to my optimal trade entry. Just copy this down. If you guys want it to look exactly like mine as well, here's some other stuff. Just copy this down and just mark it from the swing highs to the swing lows. So basically what we want to do is the optimal trade entry is just the entry area where we can have either a deep premium or a deep it just marks out deep premium or deep discounts. Just in this range alone is just like where we want to see shorts, right? And if we're going shorts in this area right here, we want to see the shorts, and this is where we're going to have the highest conviction of shorts. Um, yeah, and it also like it gives you just like a very, very good entry. The best area right here is at 709, I mean 705. At 79, if we close above it, I'm sorry, but it just lowers the chance of the thing working. So we already talked about logic. We already talked about this part right here. I mentioned that to you guys already. And yeah, basically, if it just literally just retraces into it and you see like a good reaction and it aligns with the narrative of the market, that's the model. And if you can align that with the fair value gaps, like I did so previously here, that just increases your win rate a lot. This is a high probability precision entry. Invalid optimal trade entries is if there's no displacement before this, before the pullback. If we have it in the equilibrium, like there's no like premium or discounts, and if structure did not like, if we didn't sweep anything, if it's just like some random range, if we didn't touch into any like premium discount area and it's just like a random range, then it just means nothing. And yeah, just here's a little bit of a checklist. And you use this to target like internal and external liquidity. Internal being like the partials. So let's look at here. Let's say right here, I want to go long, right? Boom. What is this? Relative equal lows. Like I mentioned before, this is a high probability sweep. So we sweep this. Let's actually see if there's any time zone. Oh, boom. That's also London session low right there. London session low, relative equal lows. We sweep this. London session high, relative equal highs. This is a perfect draw on liquidity. We move up, right? Let's see. Look at this. We have a little bit of a displacement up. This is the optimal trade entry right here. You enter longs right there on the 0.75. Push stops at the like the break, like the low right here. And we target the external liquidity, right? But this, everything here is internal liquidity. This can be your partials. You can de-risk slowly right here. Mind you, this is like, I didn't trade this time. Like this is me just like putting shit together, right? This is me putting it as I see it. And it just happens to be exactly what I'm telling you guys. You guys could use this stuff to, predict it as it's happening live. And here's a little bit of a template. Pause it if necessary. Okay. Let's move on to just time and macro. This is probably the most important part of the lecture. All right. I'm hoping you guys are enjoying this so far. I really am hoping you guys are enjoying this so far. Basically, we want to put together time and macro. So during the time, there's specific times where we have fake out moves and we have displacements and we have consolidation. It's literally all time based. So a Judas swing is one of the most important concepts we need to know. During market open 9:30, what's going to happen is we're going to have either we're going to just like have the move that is necessary, like the move that we're planning on doing it through the day, or we're going to have a little bit of a Judas swing, which is a fake move. It's like a sharp spike down or up that is opposing to the actual narrative of the day. It's literally as a way to just manipulate and take out liquidity. That's all it is used for. I'll just find a good example. No, not there, because bro, freaking it sucks here. Time. See, like right here. Originally, so this is on the 5 minutes, so you won't see it on the 1 minute. Actually, let's just try to find it on the 1 minute. So I just have to like scroll back a lot though. So look right here. 9:30 opens up, and you can also have like a little bit micro Judas swings. So this long right here was a Judas swing for this Judas swing, which took out these lows. That's like the whole point of this move right here, is to take out these lows. We took out those lows, and then the overall narrative for the day was longs. So we shot up after. This right here was a fake move to take out these internal range liquidities and this just prominent low. Let's see if that aligns with any kill zones. Oh, it doesn't. The indicator I'm using doesn't go this far, but you know, potentially this could align with some kill zones, or you know, higher time frame fair value gaps or whatnot. We also have opening range gaps. Unless you won't see opening range gaps unless you have TradingView Premium, or you're trading on like a funded account. But if you hop onto regular trading hours and not extended trading hours, these are gaps that are formed within the market. All right, so let me hop onto the 1 minute. Actually, it's more precise. So let me mark it out, and we usually mark out quarters of this open range gap. The Judas swing, a lot of the times, touches into the opening range gap and then goes away. So if I mark this out all the way, you guys will see. Judas swing, what happened? Boom, we came down, we touched into the opening range gap. See, because it's like the first actual proper move from 930, we touched into opening range gap. We touched around the 50% zone. We didn't close below the 50% zone. If we close below the 50% zone of the opening range gap, chances are that's not a Judas swing, but that's like a move to the lower, and we're going to be targeting this liquidity right here, or these liquidities right there. But we touched into the opening range gap. I can guarantee we probably took out liquidity, and now we're going longs. This is the overall move that was supposed to occur throughout, right? And again, we still didn't close below the opening range gap, but it served as a target as well for the other move I was telling you guys about. So if I mark out midnight open and 8:30 open, chances are we are above both. We took out all the liquidity. 9:30, like 10:30, sorry, 9:50 occurred. We're in the macro. We're at 10 a.m. macro now, right here in this area. We made a move around here. We retraced. Chances are we are an OTE as well. Chances are we are an OTE as well, optimal trade entry. This area right here would have been a high probability short, because we are above both 9:30, 8:30, and midnight open. Above both, you could target midnight open or even the consequent encroachment of the OTE, which kind of aligns with this swing low right there. Bring that towards there. That would have been your trade. Mind you, there's other concepts that we learned that kind of show up here. Order blocks showed up here a lot. So this would kind of be like an order block right there, which we retraced into and then had a continuation off of. Fair value gap showed up here a lot, right? There's one fair value gap re-entry here that you could have caught into this low again. A lot of things I taught you are showing up, which you guys could have profit off of. Now, 3 SMT divergences. These are also very, very important. Basically, whenever we have a pair, there's also a correlating pair. So if we look at, you know, NASDAQ and ES, these are correlating pairs. As you can see, let me go to extended trading hours here as well. As you can see, when NASDAQ goes up, ES goes up. When NASDAQ goes down, ES goes down. When NASDAQ consolidates, ES consolidates. These are almost like the same pair right here. When I'm showing you guys, it looks almost exactly the same, right? You guys can see it looks almost exactly the same, right? But sometimes what happens is ES could take out a high or a low that NASDAQ still has to take out. This becomes a divergence. So a good example being here. You see how NASDAQ took out this low right there, but ES still had to take out this low. This is in itself a good indication that maybe we're going to go long, either long term or short term, which was a short term long where we tapped into opposing liquidity that I mentioned before, right? It's all adding up together. This would have been a good SMT, you know, that's what it's called, the divergence. And boom, SMT divergence, targeting what? The opposing liquidity. But mind you, you can't be using anything I teach by itself. You have to pair it all together. It's just important to do that. We have macros and 10 a.m. macros. Basically, it's between 9:50 and 10:10. The times in that window, either we're gonna have a continuation, a reversal, or an expansion. Right? Continuation only if the morning displacement was real and it wasn't a Judah swing. Reversal, if we had a Judah swing in the morning move, we will flip and we'll do the actual move that's necessary. An expansion often it's like just basically displacement and it just breaks internal structure. Now we also want to look at news. News is an important driver of the markets. If you have a high impact news, we want to pair that up with the strategies we have. So if we have there's different noise levels to this. There's medium, high impact, and low. We don't want to be trading crazy high impact news because these news drivers, like, it's just really volatile. You can get stopped out. Even though it will hit your profit target, there's a chance that it might come down, stop you out, and it won't even fill you in. Your stop loss won't be activated and you will lose a lot more. We don't want to be trading these high impact news. And sometimes leading up to these high impact news as well, the market slows down. So during the non-farm payroll week, we have a like the few days beforehand is super choppy, it's super slow. The market conditions are not good to trade. I'll talk about market conditions in the next module. But in this case, these are pretty good things to look for, right? You don't want to be trading no news at all because the markets are going to be choppy, but you don't want to be trading very, very extreme high volatile news. But also one thing we want to look at is this may be seen as a little bit of pseudo economics in the academic sense, but high impact news and these drivers are actually it's excuses for markets to hit certain levels, right? So if we look at, for example, let's go onto the daily chart on NASDAQ and we look at, wait, let me turn this execution thing off on the daily. There's going to be too much. This is just a daily time frame. If we look at this, around when did Trump start talking about the tariffs? 26 tries. I think it was October, right? Wait, when did Trump announce tariffs? Like just tariffs in general. It was April 2nd. If we look at the month of April, where the fuck? Wait, what the heck? April 5th? Was he even in presidency that time? Let's check China. China. October 10th, around that time. So if we look at October, you guys can see there's big dumps down. These dumps down could be seen as us taking out liquidity zones. And this is, I think he re-announced tariffs again. These dumps are us taking out liquidity zones, right? This dump took out liquidity, right? Even if we look at an event, which I don't want to name drop, that happened a long time ago when people were getting super sick, right? Around 2020, I think it was around this time, if I'm not mistaken. Those news was hyper exaggerated to especially tariffs as well. It was all hyper exaggerated. Everybody was talking about it because it was like a way to push prices down on every single stock. Right now I'm talking about NASDAQ because it's a collection of stocks. ES was doing the same exact thing because this is just a collection, it's indices, a collection of all the stocks, right? We're trading baskets of stocks here. It was a way to bring down prices for everything, making it cheaper for investors to get in. Peep that. News is excuses sometimes to push price to a certain level to make it either more cheap or more expensive. And again, this is kind of me repeating myself, but you have to trade high volatility areas. London session is pretty good. New York session is pretty good. Avoid a low volatility place because it just ranges. Unless you have a strategy. Of course, if you have a strategy for Asian session and these low volatility conditions, some people like to trade chop because they have their own strategies on a lower time frame. Go ahead. It all depends on strategies. So now I want to talk about strategies, and after this I want to kind of give you guys a little bit of a bonus and talk about psychology as well. I'll give you guys the best psychological tricks to beat trades, win trades. But basically what we want to talk about is, first of all, there's I told my friend to make this part, but SB is not smart breaker model. SB is a silver bullet. It's basically trading like a fair value gap after the expansion move at a certain time frame. I forget the time frame. Wait, silver bullet time ICT. So there's a specific time that you want to trade a silver bullet. There's like a window. It's right here, and you want to just trade the first, I guess you could say, the breaker or the first fair value gap in that time frame right there, right? That's that strategy. There's the Shermain's model. I think he probably got this one wrong as well. But Shermain's model, it's not his model specifically. He just trades it. Shermain's a really good YouTuber as well. That I watched learning. But what we want to do is basically, if we are above midnight open and we are above a 8:30 open around 10 a.m. ish, and we see displacement shorter, to lower to target liquidity zones, you want to trade off the first PD array that shows up, either order block, fair value gap, what's it called, optimal trade entry, etc. Me, I have the discretionary model. I usually just try to figure out what the trend is, what the narrative is. I mark out the highs and the lows or whatever. And then when I see specific levels get taken out, I kind of mix Shermain's model a little with my model and the silver bullet. When I see certain levels get taken out at a certain time, I mark out the fair value gaps, optimal entries, order blocks, etc. And I only trade ideal conditions. And I have to mix at least two confluences, but I like to mix more. The more you mix, the better it is. So if you have 5 confluences telling you long at a certain, literally at one level, that's a very, 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 very high condition area, right? That's a very, very high probability trade. If I have a fair value gap that is in premium, where we are in deep premium, we're both above 8:30 and midnight open. We had our Judas swing. We had an optimal trade entry at that area, let's say 0.705. We had the consequent encroachment, the 50% zone of a fair value gap, and we had proper displacement beforehand. We took out liquidity, and we have good liquidity zone later on. All that together is that's a very, very high probability setup that I would trade. And yeah, you just want to identify high probability conditions, right? And the best way to tell is how is New York kill zone looking, right? How is the New York time frame looking? How is the macros looking? Are we actually expanding or are we consolidating? We don't want to trade consolidation, or I personally don't want to trade consolidation. Is there crazy news coming in the next 30 minutes? So sometimes there's red folder news is occurring at 10 a.m., right? Am I going to trade 9:30? Potentially, maybe I'll try to catch the Judas swing, but chances are 9:30 might be a little sloppier than it usually is, right? Because we have red folder news coming up later. right? And this is a really, really major red folder news. There's like levels to that shit too, or to that stuff as well. Sorry. How's the structure looking? Do we have clean premiums and discounts? Do we have clean liquidity pools, or are there just messy ranges? Is it just chop? Is it just inverse fair value gap after inverse fair value gap after inverse fair value gap after fair value gap? It's just straight chop, straight consolidation. We don't want to trade that. That is not necessary. That's a lower probability. And also, do we understand where the market wants to go today? Do we have good draws and liquidity, right? If all three of this is yes, like we have good structure, we have clean structure, there's no messy overlaps, we are in a kill zone, we are aligned to macro, and there is like no like crazy news coming up. Do we have a narrative in mind? This is a high probability day. This is a day that you want to trade. If one isn't in this as well, if one isn't in this, and like let's say and also there's like priorities to it. Let's say the narrative, we don't understand the narrative. Like just trade with super caution. Like I personally wouldn't trade it, but if you want to trade it cautionally, right? And if two or more fail or two or all fail, just don't trade at all. Get off the charts. You're just gambling. And just there's specific days we want to avoid. We want to avoid days where there's like no sweep, no displacement. There's just straight chop. We want to avoid pre-CPI. We want to avoid FOMC, right? We want to avoid NFP. We want to either avoid NFP like the day of or 2 days prior, 1 day prior. It's sometimes it's just not clean. It doesn't move properly. And we want to avoid where there's just overlapping of like highs and lows everywhere. There's just no clean direction. So like a good example of that would be if I hop into, like, I guess you could say like, okay, well, let me go to here. If I go to MNQ and I go to like this right here, I don't want to be trading this at all. It's just consolidate. There's no high probability moves here. This is not a good day to trade, right? This was a nice like move right there, but let's say let's go to a previous 930 move, right? It's December 4th. I want to go to like this, like see this is not a good day to trade either. Yes, you could have caught in a trade here. Obviously there's people that have their own models, but I wouldn't want to trade this because look how sloppy it is. Look how slow it's moving up. Look how it's like chopping up back and forth, back and forth, back and forth, back and forth. Usually what I would like to see is just like a big spike up down, right? Spikes ups and downs. These are high probability. This is just chop. I don't want to trade this. It's hard to find entry here. You will get fucking or flipping stopped. You don't want to trade this type of stuff. You don't want to trade these consolidations here, right? This is lower probability. What are you really even looking at? What data are you getting? You won't be getting any clean fair value gaps. You won't be getting anything like noteworthy, right? You don't want to be trading those days. That's all for today. This is a really, really long course. I have something for you guys down below if you guys want to work with me, right? Because, wait, let me zoom in on this. This is a lot of information. And, I gave you guys the key to success just now, right? But the thing is, I understand that this could sometimes be super, super hard to fully digest. So I want you guys to watch this video multiple times, perhaps. Go slowly, and take notes. Do your own due diligence, do your own research aside from this. But if you guys do want, I guess you could say, somebody to help you guys out, click the link in the bio and I'll be there to guide you guys, right? You guys can follow the link. It's literally just gonna help you out. I'm gonna help you out one-on-one. All right, that's it for today. This is an hour-long video, an hour and 20 minutes of just pure sauce. Oh wait, I forgot about psychology. Okay, for psychology, you just gotta get into the right state of mind. You want to be zen. You want to be clean. Like, I don't know how to explain. Like, you want to read books, for example. You want to have your consciousness. You want to be conscious when you trade. You don't want to be foggy, right? You don't want to be jumpy. You got to understand that this is not like any other business. The more work you put in, the less value. Like, the more work you put in the sense that, like, just trading all the time, it's worse because you want to trade a little less but have the perfect trades, right? And also to do with like it's like, are you doing, how's your outside life looking? Are you you know, are you working out? Are you hitting cardio, right? Are you worshiping God, right? God is really important as well. um there's a lot of stuff to it, bro. There's a lot of stuff to it, to your psychology. I'm gonna make a more specific psychology based video later on, because there's a lot to it. There's way too much to it. um but yeah, if you guys did enjoy this video, smash the like button. If you do want to work with me one-on-one, click the link below, and I'll guide you guys to success. Anyways, thank you for